In this presentation, we're going to record into Excel transactions related to the purchase of a subsidiary using common stock. In other words, we're going to have one company fully purchase the net assets of another company, as we have seen in prior presentations. However, this time the purchase will not be for cash, will not be for bonds, but with the use of the issuance of common stock. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We got our information on the left-hand side. We're going to be entering that information into the blue area on the right-hand side and then posting that to our trial balance, where we have the beginning trial balance entries and then the ending trial balance. So what we have here, we're going to have our information on the right. We're going to say that we have P and S. So remember, P is always going to be the parent and S going to be the subsidiary. It's going to be easy for us to remember, hopefully, in that way. And P is going to be purchasing S here, and to do so, they're going to be not paying cash, but in this time issuing shares of stock, which is another quite common type of way. So we have P acquires all of S assets and liabilities for its common shares. P issued shares of 8,400 that had a $60 selling price at that point in time. So that's going to be the market value, is going to be that $60, and the par value is up here at the $8. Okay, so we'll get down to that in a bit. Same kind of thing. Okay, so we got P purchasing S. So notice what happens here is in this format, we have the value in terms of the book value and the fair value for P, book value, and the fair value for S. Now what we really need here, of course, is the fair value for S. That's what we're giving here. So because we're going to record this transaction for P, P is purchasing S. So P is purchasing S just like a market transaction. They'd want to say, okay, what does S have? Well, we have assets and liabilities here, and we want to know not just the book value, but revalue them to the fair value in a market type of transaction. So we got to revalue them to the fair value, and then we're going to record them for P on basically the fair value method. So with all these columns we're looking at S's, that's the one we're going to be focusing in on, S's fair value. Now again, it's a little bit more confusing in practice, of course, to go through each line item by line item and figure out the fair value. That's a task that needs to be done in practice in here, but in a book type of problem, or just in theory in general, of course, that's what you need to focus in on. We're going to have the book value numbers. We're going to have to then break them out to the fair value numbers when we're talking about a purchase type of acquisition like this. So I'm going to break this out similar to like we've seen in the past. We're going to do a similar type of process. I'm going to construct the journal entry in such a way that it makes sense, not necessarily putting debits on top, just how it would make sense, right? We're going to say, all right, this is P's books, the parent's books. P's going to be getting cash. So cash is going to be going up. So I'm just going to record this out. And then the major thing we got to remember until we get down to that new thing down below, which is the equity being distributed, the common stock, is that we've got to be pulling from the fair value line. So we're just going to go through this a long time. These are long journal entries, but they're not that difficult once you just know which line item you're pulling from. And if you're doing this in Excel, it's a lot easier, because it's not that hard with a calculator either, but it's easier with Excel, that it'll help you out with a calculation so you could focus in on just understanding the process. So we're going to be picking these up. If you do this by hand, even though it's not that difficult, it takes a long time, right? So we're going to say, then we'll pick up the depreciable assets. Now note what we're not picking up here. We're not going to be picking up the accumulated depreciation. Why? Because we revalued the fair value. So we're going to say, yeah, this is the book value. We're going to think of it basically as book value. Then we're going to revalue it to the fair value. We're not going to put the book value on our books as we're the purchaser here. We're just going to revalue this to what we believe the value is at that point in time, then depreciate it down as we go. Then we have the accounts payable, and this is going to be a liability, so we're going to be picking that up. Now, oftentimes, of course, the liability, because it's just cash, is going to be the same, book and fair. We would be taking the fair if there is a difference, however, still. And then we have a note payable, so that's going to be a liability. This one does have a difference between the book and the fair value. So I'm going to say, I'm not sure exactly why that would be, but I'm going to say, all right, I'm picking up the fair value there. And then we're going to then say that we have the stock that we're going to issue. So this is what we're getting, basically. So you could say, okay, this is what we're getting, assets minus liabilities. That is the net assets, the 438,000. What are we issuing for this? We're going to be issuing common stock. So I should be calling this common stock. So stock. So we'll say common stock is going to be issued. Now we have a par value of $8 and then a market value. So remember the par value, this is from like our corporate stock stuff. So if you got questions about the issuance of stock, we have a course on issuance of stock and whatnot. But just remember that the par value doesn't represent the market value. It's just kind of a placeholder type of value. So we have to say that the common stock is going to be, I'm going to say negative. I'll do this calculation over here. And it's $8 par. So I'm going to say we issued $8,400 times 8. So 8,400 are the number of stock times the par value. That gives us the 67,200. Now we have to have the additional paid in capital. So the additional paid in capital is going to be the difference. Now you might think, well, it should be the difference. I should just be taking what, what we got minus that. But no, that's not really the case, because we need to put what we paid on the books, at the market value. So we basically have to market value our common stock here. So we just put the par value here. Now, if it's a publicly traded company, that's not difficult to do, because it's traded on the public stock exchange, so we can kind of see what the value is. If it's not publicly traded, that can be a little bit more difficult. We might have to then take, our information over here, revalue our fair value to determine basically how much it's worth, the stock that we're issuing at. But here we're going to say that's been given. We're going to say, okay, that's going to be $60. That is the market price. So the calculation then, we're going to say, all right, well, let's say equals, I'm going to say negative, I'm going to put brackets around this, and I'm going to say, all right, well, it's $60 minus, oops, I pulled up the calculator, I think. Didn't want the calculator. Well, let's put it up here anyways. We might use it later. So we're going to say $60 minus $8 times the 84,000, and I missed the times. $60 minus, well, let's think about that. It's $60 minus $8, which is 52 times, and then I'm going to say times the number of shares, which is 8,400. Now, there's a couple different ways you can calculate this. This is how I would think about it in this situation. It helps out with a calculation here that we can do with a journal entry. In other words, we're going to say, all right, it's $60 is the fair value. We've already recorded minus $8 per share. That's $52. $52 left over per share times the number of shares. So times the number of shares is going to be 8,400. And that's the 436.8. So in other words, if I was to take out, you can think about it this way. If I was to take out the 8,400 minus 6, or I'm sorry, let's do that one more time. This is going to be 8,400 times 60 at the market rate. That would be the 504. And then you could say that would be the total. So that should be this plus this. There's the 504. And then you can also calculate this by saying, all right, minus the 67,200, the par value being represented there is the 436.8. So a couple ways you can think about that. Now we're still not in balance. This is what we paid now. This is basically what we paid in the format of common stock. This is what we got. So we got this amount. So let's pull up the trusty calculator one more time. Trusty calculator. We got this amount up here, and that's going to be, I'm going to say the 438,000 minus what we paid in fair value, 504 minus 504. That's going to be the 66,000, right? Or we can also do that with just the plug formula, given our debit and credits the way we laid them out, which is still very nice. And there we have it. So let's go ahead, and that's going to be a debit that we need. Let's do the negative sum or plug formula here. Plug formula, negative sum. And there is that. What's that going to be going into? It's going to be goodwill. So that's going to be goodwill. So that's how I'd construct the transaction. Let's go ahead and record this out. So we're going to say this is the beginning trial balance. And notice I took this beginning trial balance basically from the book numbers. So when we think about what's going to happen on the books, obviously we may need for P Company to break out the fair value in order to think about what this number should be if it's not a publicly traded company, which would make it easier. But obviously, when we record the transaction, we're going to be recorded to P's book, book numbers over here. So these are P's, the parent company's book numbers. Then we're going to record what we got. So we're going to say, all right, this is going to be equal to the 97,000. Inventory is going to be the 166. Then we're going to say the depreciation, the 249. Then we've got the accounts payable down here, which is going to be the 40,000. Then we have the notes payable, which is the 34,000. And then the common stock, which is going to be the 67.2. That's what we issued. And then the additional paid in capital that we issued. So the 436.8. And then the goodwill up top. Goodwill at the 66. So similar transaction to what we've seen in the past, just a little bit different in terms of the accounts. We could see a couple different ways on that. And then of course the payment function down here being different, but whether we use cash, whether we use the bonds, whether we use the stock, we could still result here in, of course, this calculation of goodwill with this type of transaction.